What's going on, everybody? Welcome back to the channel for another institutional breakdown. Today's lesson is going to be on USDCHF, but we're going over a trade I took earlier in the week using the central bank dealers range and a few other concepts as well. Absolutely nailed the low of the day. So if we come into the chart, we see what happened the previous week. We have Wednesday, they set a high here, traded down Thursday. On Friday, they traded back through this high again and set relatively equal highs, or what retail would look at as support and resistance. Above these highs is buy-side liquidity. We have willing buy participants in this market, willing to take price higher if this price is traded to. You also have stop losses resting from anybody who got these two moves correct as a form of buy-side liquidity as well. So looking at that and knowing how the market moves on liquidity, coming into the week, I had these marked up as an area of where I would potentially like to see price trade to. If we look at what happened on Sunday, this is your Sunday opening price here. They traded above Sunday opening price and then started to trade down below. On Monday at 9:30 for your New York session, they rated your Thursday's low. When resting under this low is sell side liquidity. So if we move down to, let's go to a smaller time frame so I can give you guys a little closer look at the central bank dealers range. So your central bank dealers range will aid you in nailing the higher or low of the day in conjunction with other concepts. So your central bank dealers range starts at 1400 and ends at 20, or basically 2 p.m. Eastern to 8 p.m. Eastern. Inside of this small range right here, you see it's just a small consolidation range. This is your central bank dealers range. And we can use this range in line with our overall bias, which my overall bias, as I mentioned, with the sweep on the sell side under Thursday's low and the buy side liquidity resting at these relatively equal highs here. And I also had the underlying bullish narrative on dollar to start the week. I had a few higher objectives that needed to be ran out. So with USDCHF being a USD-based pair and dollar, in my opinion, was to be bullish to start the week off, we should be seeing USDCHF look for the upside. So from 1400 to 20, we have this central bank dealers range, and we look to use this range by cloning it. So basically you would hit it, clone the box. And if you're looking for bullish prices, you would start marking the boxes to the downside. Each one of these boxes is what is called a deviation. So one standard deviation is one box of the central bank dealers range. Two standard deviations is two boxes, and three standard deviations is three boxes. There's actually a very sweet spot on the central bank dealers range is at 2.5 standard deviations. So 2.5 standard deviations would be two of these boxes and half of the third one. How do I find half? Well, I take my fib and I just mark from the high or low of the box, and at the 50% of that third standard deviation, you put a trend line. That marks your 2.5 standard deviations. You have your 2.5 standard deviations. So you have your central bank dealers range, which is a little handy tool that you can use. Now we get into our 12 o'clock opening price. So here at 000 is our 12 o'clock opening price on USDCHF. If I'm underlying bullish, I want to see price trade under the 12 o'clock opening price prior to London open. So 12 o'clock opening price, or 12 o'clock candle here, you have your opening price here delineated with this trend line. And what I did was I took this tool here to measure a range. It depends on the volatility of the pair you're trading. On USDCHF, I chose between a 20 and 25 pip range from 12 o'clock opening price that I would like to see price trade down to. If you're trading, say, a GBP pair, it can be 30 to 35. We don't necessarily want to see larger than a 30 pip move, but it can be a little larger. So on USDCHF, I chose around a 20 to 25 pip range that I wanted to see price trade below of the 12 o'clock opening price. And in conjunction with that, my central bank dealers range, 2.5 standard deviations, comes in at 20 pips under the 12 o'clock opening price. So we have our Judas swing that happens after 12 o'clock, basically a false move before the London Open. I have my central bank dealers range marked up, and I know that if I'd like to see price continue to the upside, I want to see bearish price action into these deviations. If we draw our fib from the swing low to the swing high of the range, the current trading range that we're in, we have our sweet spots of 70 and 79, which is your OTE levels. Anything under 50 of this range is a discounted range. So when you're looking to buy, you don't want to buy at a premium, you want to buy at a discount. Ultra discounted prices come at 70 and 79, which is your OTE level. Price trades down to your OTE levels at 3 a.m. in the morning. You have your Judas swing. You have 20 pips from your 12 o'clock open, and you have 2.5 standard deviations, and you have your OTE levels. We move to the 30-minute time frame, and we look at the range here between this down move and this large up move. This created what people would call a fair value gap on the downside and a fair value gap on the upside. What we do is this range in between here, from this wick to this wick, can be used and looked at as an order block. So this range being used as an order block could be looked at as an order block, also overlapping with your 2.5 standard deviations, also overlapping with your optimal trade entries. This in my eyes was a high probability setup. So at 3 a.m., price traded down to the area of where I wanted to see entries. And with all of my confirmations, everything playing out exactly how I wanted to, with the pre-London drop to our areas of interest, I didn't hesitate. At 3 a.m., this was a down candle. This was a down candle here, and I bought USDCHF. I also called it out to my signal service. I said, hey guys, buy USDCHF. We're risking 10 pips. Our target is 48 pips, aiming for these relatively equal highs, coming in at a 4.87 to 1 odds. So for every dollar you risk, you made $4.8 back. And if we just zoom in and look at the entry it gave us, wick entry, and speed. When you're correct, you will see speed. Very little drawdown and speed. Time and price is your best friend. Your London kill-zone hours are between 2 and 5 a.m. So London kill-zone hours are between 2 and 5 a.m. That's when you should be looking to enter the market for London if there is a setup that presents itself. When you have multiple confirmations, it gives you more confluence and more confidence to enter into this market. Now, I want to go over the exit. So the exit was the equal highs or the buy side liquidity. Knowing your exit is just as important as knowing your entry. Why do I say that? Well, above these equal highs here, there is what? There is liquidity. It's a liquidity. we know that the market moves on liquidity. I chose this target because I knew that no matter if they want to continue to the upside or continue to the downside, this price point has a high probability of being hit. Comes in, hits our TP, retraces, goes up 7 pips higher than the chosen target. And completely unfolded. And what was their target on the downside? Well, equal lows or sell side liquidity coming in from 1, 2, 3 weeks here. But even if their objective was to the downside, you were able to catch this 48 pip move to the upside based off of liquidity pools and understanding how the algorithm will reprice to liquidity pools, and it remembers old highs and old lows, and that happened to come in and set the high of the week. Why did it set the high of the week there? Well, dollar ran up and cleared out daily highs and happened to set the high of the week. And they used this liquidity pool of willing buyers, a buy side liquidity here, to fuel their shorts. So the central banks, essentially, for them to sell, they need willing buyers. For them to buy, they need willing sellers. So in this instance, they had willing buy participants or buy side liquidity in the form of buy stops, breakout buyers, retail buyers. They used their buy side liquidity to fuel their shorts to the downside. Understanding how the algorithm moves towards liquidity is a very big key to success. So I appreciate you guys tuning in for this video. If you have any questions, leave some comments. I also wanted to touch on, I do have my Signal service up and running. I will drop the link to the group in the description of the video. If you have any questions, hit me up on Instagram, hit me up in the comments. I'll get back to you guys. Much love to you all. Stay safe.